Sanjeev Goenka Group, growing legacies.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Umesh Mehta of Samco Securities, Ritesh Ashar of KIFS Trade Capital, and Avinash Gorakshakar of Joindre Capital join me on the show. Thank you to all for joining me on the show. Now today on Hot Money, we'll discuss firstly the NBFC space. Yesterday all of them rallied, but in a matter of seconds today the entire wealth has been wiped out. We'll talk about Zee Entertainment. Came out with a pretty strong set of numbers. The counter is reacting. What's the view ahead for Zee Entertainment? Something seems to be going wrong for ICICI Securities. Despite the markets moving up yesterday, also the counter traded at a 52-week low. And is there any mid-cap that they will bet on after the carnage? For a long-term perspective, that's something that we'll ask our guest at this point of time. But firstly, let's start with the NBFC sector. Now, yesterday was a day in which there was enough traction. Most of the NBFCs were up anywhere between 10 to 15%. But what we are asking here is that, was that a short covering rally? Is this here to stay? And most of them have corrected from that level. So we're back to square one. So what should one do on NBFC sector now? Could there be more potential short covering? Is there genuine weakness, or should this sector be totally avoided? So Umesh, the NBFC sector, so we're back on square one. Yesterday people missed the rally. So whoever missed the rally now has an opportunity to get it at the same price. Correct. What's your view on the overall sector, and any NBFCs that you think are worthwhile buying for at these levels?
Correct. So finance is a business of trust and liquidity. So both got impacted in the previous month or so. So trust in a sense that people tried to question the asset quality given the ILFS fiasco, etc., etc. Second, the liquidity. So liquidity was a natural, tightening was a natural phenomena because GSEC rate had increased by 1.5% in a matter of 6 months. But market did not realize that, and when things started to tighten up, they thought that liquidity situation is serious. But that is really not the reality. The reality was a trust factor, given the ILFS saga. But I think all said and done, finance is a game of liquidity. So ILFS assets are illiquid, and if people want that money, please give my money back, that can't happen. So this is how, but I think more or less market has stabilized. So now let's understand valuation. So what are the attractive valuations historically? So Bajaj Finance at time was trading around 3 years back, it was trading at 4 times price, 5 times price to book. Currently it is available at 7.5 times price to book. So valuation is still not comfortable given that huge run-up that we had seen in terms of scarcity premium, in terms of quality. So even housing finance companies, they are available at what, 3.5 times still. India Bull Housing Finance is available at 3.5 times price to book. We believe still if correction comes in, prices come down, still it is better. But the asset quality is intact. So I think that's the thing that investors should really look out for. If asset quality is intact, there is no reason why NBFCs should be avoided. Because if you understand, Warren Buffett started to acquire Wells Fargo in 1980s. And he every year or regularly he has been adding to that portfolio, because compounders are the one which belongs to financial sector. And avoiding financial sector completely and oh my god, let me get out because there is some problem is a bad idea. So the real compounding of wealth will happen in this kind of stocks, and NBFC.
So which do you like? So which are the good NBFCs after the massive correction? There will be some stocks which you find value in.
Correct. So I think housing finance as a sector, so India Bull Housing Finance and even DHFL, please 60% correction is huge enough. So in terms of price correction. And of course, reasonable correction has happened, reasonable valuation are available, but market has a habit of overreacting. So we believe there will be slight amount of further correction, or the prices will correct further and valuations will be mouth-watering. That's the time one should really invest. But currently, if someone is holding stock and is thinking that, oh my god, I should have got out at a higher price, so for them, I think it's time to keep patience and switch off the quote screen if that is paining them. But I think it's better to hold on to a quality NBFCs.
Okay, Avinash, your view on the NBFC side. Most of the NBFCs have actually come out to the day's high. Most of them have come into the green. It's recovering. What should one do on NBFC at this point of time?
No, I think I agree with Umesh that longer term, the NBFC sector will do well. I think the PSU banks are not competent enough to actually, complete the role what NBFCs perform. But overall, I think looking at the liquidity factor, I would believe that the next, say, 2 to 3 quarters could be challenging. Not only because of the ILFS saga, but because overall liquidity is tight, and hopefully, the second quarter numbers will be decent, the asset quality will be good. But thereon, I think it's going to be definitely, a separation of the bigger players versus the smaller players. And I think in that perspective, I think bigger players like Diwan Housing, typically India Bulls Housing, or even, companies like Mahindra and Mahindra Finance, which has been beaten down quite badly and operate in the agri financing space. I think these would be good bets only for, investors who can take a longer term bet and who are willing to see some further pain in the short term. I think overall balance sheet quality will be important, but it's better to focus on the large operating players here rather than going on the second rated players here. And clearly asset quality will be the buzzword, once the Q2 numbers are out. Management commentary now will be very closely monitored by the analysts, looking at what kind of loan book growth and liquidity measures are being taken by these companies.
Okay, Ritesh, anything that you find value in after the big NBFC correction?
See, my overall focus on the NBFC, it will be a low growth and higher cost in terms of disbursement. So when there is a low growth and higher cost of disbursement, it will be quite challenging for the NBFC sector for a shorter span of time. Simultaneously, IL&FS issues has created an eye-opener for all the regulatories and the entire sector per se in terms of leverages has been provided. So I feel the RBI is going to be more tightened in terms of, refinancing to NBFC sector. Right now, in a shorter span of time, the bounce back has come only because of the regulators has come across to, Monday declare that 24,000 crore have been refinancing. We are going to contribute it, which is to 30,000 crores. So I personally feel that shorter term point of view, there will be a bounce back, but growth perspective coming 2 to 3 quarter, I feel the liquidity crunches may create a problem in the growth story in the NBFC. Apart from that, the India GDP is, expected to grow around 8.2%, but simultaneously the current market scenario, I feel it is going to be a moderate and it is going to be affect to the NBFC. When it comes to the stock specific, I personally feel L&T Finance at this point in time, at the current market price, looks to be quite fair value compared to the other peer groups. Considering that the company has 800 billions of book size, having a presence of 23 states all across, good amount of growth in terms of rural area. The growth have been reported, ROE have been reported by 13%. So I personally feel at current market price, L&T Finance is going to be my strong bet.
Okay, L&T Finance. So you heard a 360-degree view as far as the view on the NBFC sector is concerned. That's the view that you got in. The next stock we want to talk about is Zee Entertainment. It's trading, it's actually moved up significantly even ahead of the numbers. Today also it's managing to inch up post a strong set of numbers. Margins coming in at almost 34% versus the estimate of 30%. Strong revenue growth, strong ad growth. The management commentary was also rather stronger. Avinash, what did you make of Zee's number, and is it your best bet in the media space?
Yeah, I think Darshan, the numbers definitely were extremely strong, especially on the EBITDA side. I think a 34% growth in EBITDA. As you rightly mentioned, EBITDA margins were much better than what the management had estimated of 30-odd%. And the commentary was also quite strong. In fact, they expect both the ad as well as the subscription revenue growth to be in strong double-digit growth. Most importantly, the international business is also going to break even. And on the digital OTT space also, there has been some good news. The management has not disclosed what revenue they have made on the ZEE5 platform, but hopefully that is also one vertical which the management is very hopeful that this would also now be a good revenue contributor in the longer term. So overall, I think if one were to bet on the media sector, I think this is a well diversified play, a very strong cash flow generating company, and with a 34% EBITDA margin, they have the liberty to spend on increased content costs and obviously get the benefits of various platforms. So I would definitely buy it on every decline. This is definitely a portfolio stock.
Okay, what about you, Ritesh? What did you make of Zee's numbers?
Definitely my bet is also also buy on decline. But if you look at the overall result has been declared, there is a drop in the profits. So drop in the profit by almost 38%, and simultaneously revenue has been increased. In terms of revenue, domestic revenue has also increased by almost 23%. At the same time, international business has also reaches to 21%, which is quite positive sign. In terms of international viewership also, they have extended their digital viewership through ZEE5. That is also quite fabulous job. So overall advertising income has also reaches to 23.5% growth. So I personally feel as in media industry per se, it looks to be a good portfolio, considering that FMCG and other segment which are more popularized in terms of spending money in terms of advertising. At that point of view, the valuation looks to be quite attractive, but at the same point in time, the profit growth is something quite not happy for me, at least.
Okay, so that's the view that's coming in on Zee. And in the media space, you said you're happy with the valuation, but what any view on Sun TV, which is trading and continues to trade at a much substantial discount to Zee?
Definitely yes, but Sun TV has, I rightly said last time, they have to more focus in terms of digitalization and content development, and especially more presence in terms of South. Compared to Zee, it is a better bet, because Zee itself is more aggressive in terms of going towards the digitalization and content development. And ZEE5, it is going to be a strong app for the digital generation. And simultaneously, management are also expecting in next 18 to 24 months, they wants to be among the top 3 players in the digital segment.
Okay, Umesh, what did you all make of Zee TV's numbers?
So I think Zee could be the potential next Netflix of India. The way they have built their ZEE5 and 30% subscription revenue, and 40 and 60, so 60 from advertisement and balance from subscription, and ZEE5 is also really gaining traction. So I think this 30, so they are claiming that 30 minutes is the average time that people are spending on digital medium, and they have identified, and they have the first mover advantage in spearheading this movement. So I think structurally this is a no-brainer buy in terms of an investment portfolio, right? So is an integrated media player, and size does make a sense, and they are really increase in EBITDA margin, increase in revenue, ad revenues, subscription. I think they are firing all cylinders, and the best part is the stock price has really corrected. And so this is how opportunities are created, when the company numbers are great and they are growing, and stock prices have corrected by around 30-35%.
Sure.
So that makes a good margin of safety.
How do you play ZEE5? What's your outlook on ZEE5? Because it seems that you're rather bullish on that venture. What kind of growth trajectory are you seeing there?
So I think ZEE5, given that penetration, 5G coming, and the way Reliance is really trying to sell data at a far cost-effective price, so I think ZEE5 will. It's very hard to say, but I think they are going to grow at around 40-45% plus. So I think that's where the biggest revenue share, or they will be able to increase the revenue pie from digital segment, and that's going to be a bigger trigger for Zee.
Okay, so that's the view that's coming in on Zee Entertainment. Strong set of numbers, strong management commentary, and all 3 of our guests are convinced that it's something that you should look at with a positive bias. The next stock is something that ever since the listing, nothing's actually gone right for this stock. ICICI Securities now all the way down to 230, down another 4%, trading at a fresh 52-week low. So there is something, while we can say that financials have come down significantly, the stock has actually become half of what it was since the time of listing. So even when the times were good for NBFC and the brokerage space, this counter never gave returns. It's been just going one way down. So we're asking our guest, what's it that seems to be the street concern on ICICI Securities? Ritesh, any clue why? When most of them have corrected, there's no doubt, but even when times were good for NBFCs and brokerage firms, ICICI Securities somehow never just took off. It was just going down.
So believe me, the overall securities and the broking business is working on the wafer thin margin, basically. So, and the 70% of the business is all about depending upon the market movement in terms of economy, in terms of political conditions. So I personally feel in terms of security business, the growth prospect is quite limited. Simultaneously, they are moving towards the asset class like mutual fund and the insurance business. That revenue, due to regulation issues, the revenue is also slowly and gradually has been compensated in the very low margin as well. So apart from broking, simultaneously there is a healthy competition from last 2 to 3 years as a discount broking house. So that discount broking house is also trying to reducing the yield of the traditional broking business. So in terms of brokerage business also the yield is going down. Other AUM business also the yield is going down. So I personally feel the securities business is not advisable to invest in terms of creating a wealth.
Now it's down almost 50% from where it was. Our valuations now. Valuations was the biggest concern that investors had when the IPO came out, right. And that's why the subscription didn't come in, and that's why probably in a sense it also had to be bailed out in a way. It's now half of where it was. Are valuations now at a decent level?
See, believe me, in terms of tracking the business from the top to 50% down and looks to be very lucrative, that should not be the case when it comes to the fundamentals. The fundamentals should be what would be the future forecast of the product, what the companies are into. So I personally feel the future broadcast for next 1 or 2 years of time, I think it is going to be very tough for the securities business.
You think, Avinash, despite a 50% correction, if the business is failing, just don't look at the valuations?
No, I think clearly, Ritesh has a point that they have 5 business verticals. Of course, they have distribution, they have the treasury desk, but the main income comes from the retail and the institutional brokerage business. And I think clearly in a weak cycle, this business can be badly impacted. So valuations could definitely get further bad. From the IPO price, Darshan, you're right. The stock has taken a big beating. In fact, the IPO price itself was a very pricey one. I would believe that, clearly looking at the way the business is structured, at least in the very near term, there don't seem to be any major earning surprises, and to that extent the stock would definitely underperform. I think something like an Edelweiss would definitely figure out to be a much better bet. It's corrected significantly from levels of around 230, 242, around 160 odd. So here is a business which has actually de-risked the business significantly, lesser on the capital markets, and I've actually added a lot of other well-generating streams to the overall top line. So I would believe that ICICI Securities is a more focused player purely on the capital markets rather than something like an Edelweiss, which is a more diversified.
You see there's more potential downside in ICICI Securities. If someone is taking a slightly longer term view, let's say a 2-3 year view, then also would this be an avoid?
I would still believe. I think there are so many choices, and Darshan, as you must be aware, there are many security broking firms which are now lined up to go public. So competition is increasing. So obviously this is going to make the market even more fierce in terms of the margins, which are already wafer thin.
Okay, what about you, Umesh? What do you make of ICICI Securities?
So in a sentence, ICICI Securities going the Nokia way.
Okay.
So I think that's how I would put it. As a disclaimer, we are into discount broking. But anyway, so let's understand the fundamental structure of capital market, how capital market has panned out in over a period of 10 years. Since 10 years, the turnover of derivative as a percentage of total market cap has increased from 400% to 800% over a period of 10 years.
Okay.
So the number of players or the professionals who are in derivative trading have increased.
Sure.
The cash market turnover volumes have decreased over a period of 10 years from 12% to 5% of the total turnover. So a retail investor where the real ICICI Security banks upon is not there, and see the volumes, volumes of mutual fund. Mutual fund volume has gone from 4% to 7% in this 10 years. So retailers have understood what this is not our game of cup, and we can't trade and we can't make money. So let's go to mutual fund. So the major cash cow for ICICI Security have either shifted to mutual fund or they are not into markets. And the larger professional players who are in derivative have understood that saving cost is very important, because whether or not they make money, but let's save on cost. And for cost saving, they have shifted to discount brokers, and that's how
Okay.
Discount brokers are flourishing and they are growing at what, 60, 70, 80% a year. So that's huge. And they are eating the market and they are eating the pie. So typically even ICICI Security, if they want to shift to discount brokering, they can't because they are axing their own feet, because given their cost structure, given their entire setup ecosystem, they will not. And slowly and steadily their revenue stream, which major part comes from broking from a retail side, is slowly dwindling. And unless they really do out of storm brainstorming and if they really come out with different models to generate cash flow, I think this company has there is no point investing in a dying industry.
So Umesh, you work in a similar industry. Your company does it. What's the on-ground situation? Are you also seeing similar trends like Avinash pointed out that retail brokers are not coming in, volumes have fallen significantly? Is that the trend that's also going on ground right now?
So there are brokers as a category. There are few brokers who are generating larger and they are eating pie, right? So forget about market share. So market share is yes increasing, but net there is no increase in pie as a market because the number of players are stagnating. So now it's a game of who is eating the pie of another. So right, so that game eating share is there, and their discount brokerages are really making an impact, and they are trying and snatching away. To be honest, because the cost structure is so low that traders have understood that if I do active trading on a platform like ICICI Security, in a period of 10 years, my entire capital will be wiped out in terms of brokerage, but in terms of discount broker, it takes 200 years. So people have understood the benefit of cost on low trading platform, and I think that's a structural shift. So this is how technology and this is how things are happening, shaping around the world, and as a discount broking. So unless ICICI Security really does a diversification in terms of deleveraging their broking business and entering into new financial services, there is no point holding on to the stock.
Okay, so that's the view that's coming in on ICICI Security. It's a consensus avoid that our experts have indicated. And finally, in the time of carnage, which is one mid cap that you should buy and hold for the long term? That's what we are asking our guests. So Avinash, what's your mid cap idea that you say investor should take a bet on?
I think within the consumption theme, Darshan, we like Radico Khaitan.
Okay.
We believe that the liquor space is one space which is going to do well, and in fact within the IMFL space, Radico has a clutch of very strong 6 to 7 kind of premium brands. I think the Q1 numbers have also been pretty strong. 25-26% growth in revenue, 45% growth in the EBITDA, and the management commentary has been pretty strong. They have been very categorically saying that they want to make the company debt free by FY21. Already about 140 odd crores were paid in the Q1. So our sense is that Q2 will also be a strong quarter, and hopefully going forward, whatever news flow has come out on the ethanol issue, I think the stock has taken a beating largely because markets were fearing that a lot of molasses would get routed to ethanol. But here the company is self-sufficient. Our sense is that with a strong brand portfolio and a strong consumption kind of pattern, this company should do well over the next 12 to 18 months.
Okay, so that's the view, Radico Khaitan. Before we move on, just can we pull up Yes Bank? That seems to be a stock that's on a tear. The last time I saw it was on upper circuit. It's managed to move. It's come off the day's high, but nevertheless, so banking as a pack has recovered in trade today. Umesh, which mid cap are you all recommending to your clients?
So there are so many, but in order to name one, I think V-Mart is a typical stock wherein when numbers and everything is far better than Avenue or D-Mart. So let us understand, 10 years they have been consistently delivering growth of upwards of around 30%. Their operating margins are 10% and D-Mart's operating margin are 9%. So they are currently in around 140 cities, and they have a potential to reach up to 4,000 cities. That's huge, and their focus is in tier 2 and tier 3 cities. They have really managed their cost structures, and given the valuation, and valuation is also half what D-Mart trades. D-Mart trades at what, around 100, and this stock trades at around 49 or 48 odd. So I think on all parameters, this stock looks far value or relatively cheaper than Avenue Supermart, and I think they have got robust business model and they have got huge potential. I think this is one stock where can give multiple, and past also have given great returns, and we believe this stock will deliver great returns.
How are the financials been as compared to Avenue?
Far better.
Far better.
Far better than, and if not worse, then they are far better. So as I told you, operating margin at what is at around 10%, and DMart is operating at 9%. That top line growth is far better than DMart. Valuation is half. So and price to sales, but VMart is available at 2.5 and DMart is available at around 5.5, 6.
What's the trigger? Okay, you spoke about valuation. What's the trigger for someone to buy?
The growth. The trigger is the growth. This momentum is going to remain, and in order to make money, when people focus on growth investing, companies that are growing and growing rapidly and efficiently, I think those are the monies which create huge amount of wealth, and I think VMart is one of them.
Okay, and Ritesh, which one are you all recommending to clients? Any good stock that you have recommended to your clients?
Yeah, definitely. We are building up the portfolio for our customers on the Bharat Forge.
Okay, Bharat Forge.
That is basically an auto ancillary company. If I look at overall auto industry, it is going at around 7.8% on the year-on-year basis as in CAGR. The particularly Bharat Forge, it is all about like doing an export of the two-wheelers and four-wheeler spare part. Simultaneously, when it is more into the export business, they are getting lot of benefit as on today for the rupee depreciation.
Okay.
So the 60% of the portfolio comes under auto ancillary. Simultaneously, they are diversified into the infra business and the engineering business also. In Germany, German business is also growing by almost 20-21%. So I personally feel when the profit margin, profit is also growing by 30-33%, and simultaneously price to book value is also at around recent fair value price. So I personally feel at this point in time, if somebody wanted to build up the portfolio, then auto ancillary, particularly in Bharat Forge, will be a strong recommendation.
Okay, so Bharat Forge, Radico, as well as VMart Retail are the stocks that our guests have indicated for trade today. But with that, it's a wrap on today's Hot Money. Umesh, Avinash, Ritesh, thank you so much for coming to the studio and helping our viewers. Ask BQ comes up next. Stay tuned to Bloomberg Quint.